Thanks for clicking! All eyes were on StatCan this morning as it was set to release Canada's inflation data for the month of February, with many expecting an upsurge in inflation on the end of the federal tax holiday, with most economists thinking inflation would come in at 2.2. We got our answer at 8:30 this morning when inflation did come in even higher than expected at 2.6%, higher even than that which was being predicted by the Bank of Canada, which had said inflation could come in as high as 2.5.
I'm leaving you with a real pile of shit in your lap.
Yeah, definitely not what the governor wants to see, especially ahead of the economic uncertainty brought on by the Trump tariffs. In measures of core inflation, those measures the Bank of Canada cares about when assessing inflation, came in even worse, much higher than the bank would like to see, and even worse than that, accelerating. And this data comes amid the release of a report coming from the Organization for Economic Cooperation and Development, or the OECD, severely cutting back Canada's outlook for economic growth ahead of these tariffs, warning that the Bank of Canada would actually have to raise rates in a full-blown tariff war.
They wouldn't dare.
So what I'm going to do today is go over Canada's inflation report for the month of February, take a look at this report coming from the OECD and the implications stemming therefrom for Canada's monetary policy, and then go over some of the limits that Canada has in fighting this trade war with the United States. As we'll see today, inflation is heating up at exactly the wrong time. We will continue to track these very uncertain events on this channel. Make sure you click like and subscribe if you want to get those updates, but for now, let's get into the inflation rate. Onto the inflation data. As mentioned, Canada's inflation rate came in higher than expected at 2.6%. That does appear to be coming in much higher than January's 1.9%, but remember, that 1.9 was being artificially pushed down by the federal tax holiday, and that's obviously no longer the case.
You should have seen your face! You should have seen your face!
Major month-over-month upward contributors to the inflation rate were travel, tours, food from restaurants, financial services, alcohol, and household appliances, whereas childcare, car insurance, fresh vegetables, home insurance, and furniture all got less expensive last month. So, with the GST holiday no longer in effect, all of those prices get added back into the CPI, meaning all of those great reads that we had over the past 2 months, those reads which, according to the financial stewards in the media in the real estate industry, justified more interest rate cuts coming from the Bank of Canada, those reads are now over, and the real CPI is showing an acceleration from 1.9 in November up to 2.6 as of February.
Oh, that totally surprised me.
But the really big news, the stuff that's going to get Bank of Canada Governor Tiff Macklem concerned, are the measures of core inflation, with core median and core trim both rising from 2.7 to 2.9. But it's not just these year-over-year increases getting close to 3% that's going to have the governor worried, as it is the acceleration, with both measures showing further month-over-month increases. Adding credence to what we've been saying on this channel, that yes, interest rates are coming down right now. Absent those tariffs, we go back to worrying about the inflation story, which, operating in the background, isn't all that great.
Why are you being so negative?
That's why. If the data goes back to looking like this, well, that's a much more positive story. So we have inflation coming in hotter than expected, hotter than even the traditionally optimistic Bank of Canada thought it would be, and we have measures of core inflation accelerating as well. And all of this comes amid a new report coming from the OECD, which notes that global growth will take a big hit from these Trump tariffs, with Canada and Mexico set to be hit the hardest. The report says that economic growth in Canada could drop by over half, falling from 1.5 in 2024 to 0.7 in 2025 and 0.7 in 2026. And that prediction falls roughly in line with what we heard from the Bank of Canada last month, which said that the initial Trump tariffs would put downward pressure on Canada's economy and would keep economic development lower than it would have been as the years go on. With that said, the report notes that those shocks to the economy would actually help keep inflation down, at least in the short term, meaning people without jobs can't really borrow or spend, don't really have a lot of leverage when negotiating their wages, which should help to contain price increases.
That's not how it works.
And as to how much, the OECD expects Canada's inflation rate to hit 3.1 in 2025, moderating to 2.9 in 2026. So, inflation's still much higher than the Bank of Canada would like to see, even taking into account the initial economic shock brought on by these Trump tariffs. And given where the OECD says inflation is heading, up, and where it says the economy is heading, down. The report notes to the uncertain path for the Bank of Canada, noting that monetary policy has to remain vigilant. The report notes that a one-off increase in prices brought on by retaliatory tariffs is likely to be accommodated by the central banks, meaning those price increases that the Canadian government are going to deliberately impose as a means of fighting the trade war with the United States, those aren't going to be taken into account by the Bank of Canada. The bank is going to see the CPI go up and ignore those price increases, figuring that they're temporary. But, says the OECD, if inflation expectations start to rise, especially if we continue to see tightness in the labor market, then we could see higher policy rates. And we're already seeing certain signs of inflation expectations already rising, with the OECD noting that inflation expectations are already bumping up in advanced economies. And again, this also falls in line with what the Bank of Canada has been saying, as it took the time during its last policy announcement to note that inflation expectations are ticking up amongst Canadians. And if this continues, if these retaliatory tariffs generates rising wage and price pressures, then, says the OECD, we could see the Bank of Canada have to raise interest rates by 1 to 1.25% higher.
Nuts.
So, in summary, we have headline inflation coming in at 2.6%, we have core inflation continuing to accelerate, and the OECD says that Canada shouldn't expect these inflationary pressures to subside anytime soon. And heading into this trade war, elevated inflationary pressures is really not what the Bank of Canada wants to see, with even Prime Minister Mark Carney noting this week that Canada is limited in the policy options available to it in fighting the Trump tariffs. Carney noted quite rightly that we are limited in the number of tariffs that we can impose, in our ability to impose dollar-for-dollar tariffs. Were we to impose those dollar-for-dollar tariffs, that would entail increasing prices on $600 billion worth of imported goods, meaning we could potentially see inflation on $600 billion worth of the goods that we buy. That's an awful lot of artificially imposed price increases to put on an economy already seeing higher than ideal and accelerating inflation. And yeah, I think today's data just adds a whole nother element to this trade war. How much ammo that the Bank of Canada, that the fiscal authorities have available to them to fight this war with the United States. With price pressures already growing and the war hasn't even really started yet, that doesn't apparently start until April 2nd, that is going to limit the bank's abilities both to drop rates and the fiscal authorities' ability to impose costs on Canadians as a means of fighting the United States. These Trump tariffs would have been a massively uncertain undertaking for our central bank, even if inflation would have been at target. But with inflation accelerating even higher than the Bank of Canada thought it would with those tax measures removed, this adds an even greater level of uncertainty to the governor's path moving forward. We will obviously continue to track this uncertain path on this channel. Make sure you click like and subscribe if you want to get those updates. But for now, thanks so much for watching.